Good afternoon. My name is Edouard Vieillefond. I work for the French securities market regulator, the AMF. I'm in charge of regulatory policy and international affairs. I will have 5 slides. I will try not to overlap too much with what was just said. Maybe first to introduce the topic, because I heard the first question this afternoon during the previous panel, and I want to try to convince you that this debate is not a political debate. It's really the debate for market regulators, as witnessed by what is currently underway at IOSCO level. We have a number of concerns with those markets because, primarily because they are financialized. I mean, a few years ago, they were either non-financialized, or if they were financialized, it was because they were using derivatives markets for hedging purposes. As everybody knows here, the big change occurred at the beginning of the century, in the year 2000, and now those markets are more and more like investment markets, with a strong correlation with other financial markets, such as, for instance, equity markets. So I don't want to say at the outset that, of course, correlation means causality, but what is quite surprising is that when you see that correlation, for instance, with some, and the vast majority actually, of commodities markets and equity markets, it's a good question to be raised about why is there such a link, such a correlation, and why is it possible since 2000 and 2001, although before that, in the 90s, or at least the beginning of the 90s, those products were sold as something very different by the banks, specifically because they were uncorrelated to equity markets. They were even a protection against equity markets. Of course, there are other issues, market abuse, because it's more and more, it's easier to use markets to use markets to make some market abuse, especially within financial markets. You can use different markets, the underlying markets and the derivative market, but it's true also when the underlying market is a commodities market. It's all the more difficult to follow those market abuse cases as the financial information on the underlying commodities is very weak compared to what we have in the traditional financial sector. And of course, we need to implement a number of things in this area. Last point on this slide, I think it's very important to keep in mind that it's a strong point for the G20, and that commodity derivatives are derivatives like any other one. So there is no exception. There will be the implementation of all the rules set by the G20, reporting, clearing, trading, exchange of collateral when it's not sufficiently standardized to be centrally cleared. So there is no exception, and there won't be a new debate as to whether commodity derivatives should be in that field. They are in at the outset. Of course, in practice, we'll need to adapt the regulation to I would say, the specificities of these products. Second, as you know, quite recently, the G20 has a priority mandated IOSCO to work on commodities. I want to draw your attention on the word efficiency, because so far we are focused a lot on integrity, that is the fight against market abuse, on transparency of commodity derivative market, but efficiency means that we look at price formation on those markets, not only on the robustness and on the fact that there is no microeconomic abuse on those markets. We look at the efficiency of those markets because we want those markets to function well. The idea here is not to go against the markets and not to fix prices in an arbitrary manner. On the contrary, we want to regulate those markets so that, like any financial markets, they function well, they help to form the price, so that in the end they are useful for their clients, for the issuers, for the investors, especially as more and more retail investors are investing in products, the underlying of which are commodities markets. So I want to develop all the principles that have been set by IOSCO. You have the list of areas in which IOSCO produced the report on the design of the contracts, on the surveillance by the regulators, on enforcement and information sharing, and I think on helping a good price discovery on those markets. So the G20, of course, took note and even approved those measures, those provisions, but of course asked IOSCO to work a bit more on other issues, including on transparency, specifically on the role of price reporting agencies. And a very important issue today is the implementation of those provisions, of those rules, because now we have produced a lot of new rules. What is important, of course, is to be sure that everybody is playing the same game and that all the regulators over the world, including the IOSCO ones, are doing it in the right manner. So I will be very quick on this slide because you know those principles. What will be key is to check that they will be implemented in national or regional legislation and regulation, including for position management, position limits, reporting, and so on. And to be honest, we all know that the US has some advance on many of those issues. The principles in the EU, of course, will be, but this was already said a few minutes ago, through MiFID II mainly, including for the reporting of large position, the public disclosure of aggregated position, the position management and position limits. What is also very important is the reduction of the scope of the exemption. This is not something new. It came from an advice from CSER, so well before the draft of the European Commission was issued, but it's very clear, and I share exactly what was said on that. If you behave like a financial company, you should be treated like a financial company. This is applied in EMIR. This needs to be applied in MiFID II. In MiFID I, we know that there are some loopholes and that you can be a false corporate company acting like a bank or an investment service provider. And so I think you need, in this case, to be regulated. Actually, you need to be regulated as soon as you have clients. This is very simple, especially if your clients are retailers. Last point maybe on this issue. The first one is that there is a very close relationship between the two markets, the physical markets and the derivatives markets. It means to some extent there has been a contagion of the commodities markets by finance, the so-called financialization, which means that we need also to have the contagion by the regulation, by the rules of the financial market. And this is why, in many cases, MiFID-like rules, MADMAR-like rules would be very useful, of course, adapted to the specificities of commodities markets. But they would be very useful for the commodities markets, including the physical markets themselves. And this is what is happening, for instance, to some extent in the remit regulation or in the emission allowances regulation. Many ideas in MiFID or in MAD are very simple ideas. When you have a client, you should behave like this or that. You should prevent conflicts of interest. When you're also an investment service provider, you should avoid any market manipulation or insider trading. Those concepts, those notions are not only for financial markets. I mean, they are universal concepts that should be applied also to physical markets, of course, adapted to their specificities. The last point I will mention is that we need first physical regulators for physical markets. First, they must exist, and then they must be strong. Today, we have at national and European level some regulators for physical markets, for instance, in the energy sector with ACER. It's not the case for all commodities. And honestly, we feel that in the French AMF as a loophole, because today, is there any real regulator in charge of the physical markets for oil, for metals, for agricultural products? This is not the case. And to be honest, this would be very difficult for financial regulators to go in that direction. We would not be capable of dealing with the physical material, the physical markets themselves, for instance for oil, for instance for energy. We don't do that at national level. There is another regulator. So what is important is to fill the hole on the physical side, and then that there is a good relationship between the two kinds of regulator, the physical one and the financial one. And to give you just one example, the last bullet point is that in France, following the emission allowances regulation at European level, and also because we needed to have a joint approach with the French energy regulator, we signed an MOU between the two regulators to organize our surveillance processes, both for emission allowances, but also for energy products. I think this kind of example could be something to use in other circumstances, because we have done that for energy and emission allowances, but this is not enough. We are discussing with our friends from the Ministry of Agriculture, and also maybe this would be an idea at European level. Thanks a lot. I will stop here for that introductory presentation.